First of all, thank you, Brian, for having me on your show again. So we believe in a U-shaped recovery. First of all, the recovery is in place. You can look at cyclicals rallying. You can look at, copper. Copper is back up to mid-July 2018 levels. That's pre-trade war levels. Also, the survey data looks strong. So the recovery is in place. The market is pricing in a V-shape. We're focused on a U-shape because of three things. Number one, the hit on the economy in terms of the number of people working from home is 310 million people at the height. That's 95% of the U.S. population. Number two, if you look at a V-shape, this suggests that we have a pre-pandemic economic growth by the fourth quarter of this year. We just don't see it. You look at the last 6 recessions, on average, it takes about 33 months to get to pre-recession growth levels. And our third point, there's 11 million people unemployed. It's terrible, it's awful, and this is going to weigh on the economy. And then, of course, I'm going to add one more, the fourth, is that there's so much caution around the virus. You look at, in terms of spending on goods versus services, services is really lagging dramatically as people are skittish and scared about the virus. So this is why we believe in a U-shaped recovery versus a V-shape.
Yeah, or maybe the roaring 20s once again, once we all come out of this, which we will. All right, theme number 2 is more market volatility, which we've seen the last couple of weeks, in part driven by options, as we have noted very well, Gene, on this show. But you don't think, you see volatility up, but you don't necessarily see big declines overall for the market.
Correct. So for us, the volatility theme is really tied to the market headwinds and tailwinds. From a tailwind standpoint, we've got some great news. The consumer was in really good shape coming into the pandemic. Also, the stimulus. I mean, I think what the Fed has done has been phenomenal, especially when you look at how much stimulus they've applied. Of course, from a fiscal standpoint, how much Congress has applied, and it also came in early into the economy. On the negative, and these are the things that you kind of grit your teeth a little bit. Again, the virus's impact on consumer spending. You look at right now on retail stores being closed. Right now, we're in pace to close about 26,000 stores. Last year, we closed 9,000 stores. Second of all, a negative is valuations. Right now, you look at the bounce back from the March lows. The S&P 500 is up about, 50%? At the same time, for 2020 earnings, they're down 18%. We see elevated valuations. Forward PE ratio in the S&P is at 22. If you look at the FANG stocks, the $1 trillion club, you're looking at a PE of 47. And of course, the third thing is just election uncertainty. We have a lot of things going on in November. Our perspective from this volatility is that the stock market is really disconnected from the real economy. The economy is definitely growing, but we're not sure it's going to grow to the degree that the markets are expecting.
Yeah, but fair enough, but the market is disconnected from the market in some ways, Gene. I mean, we've started talking about this on this show, and I can't speak for some of my colleagues, about 18 months ago, talking about market structure, right? It's kind of like a bowling ball on a pencil is how I described it, where the top 5 or 8 stocks they're not a part of the market, they are the market. Apple at one point had a market cap greater than the entire Russell 2000 put together. Is that dangerous, or is that an opportunity?
And that kind of ties into our third theme. We do believe that as you come out of a recession, we will have a shifting investment landscape. Historically speaking, recessions have always led to a shift in market leadership. We saw this with technology coming out of the tech bubble, and we saw technology became a leader after the Great Recession. Similar to this point, we do believe that there will be a market shift. We do think, given the fact that the market is so narrow, to your point, you look at FANG stocks. FANG stocks year to date are up, 47%, but the S&P 500 is up about 6%. If you pull out the FANG stocks, the S&P 500 is down 6%. It's a very, very narrow market. We do expect it to widen. We do expect more rotation into cyclicals. The market needs a positive rotation into cyclicals. You look at yesterday's decline. We feel good about the decline yesterday because it was actually interesting that it wasn't a risk-off day. Yeah, we saw the S&P was down, we saw the NASDAQ was down, but cyclicals did well. Yeah. Financials did well, materials did well, industrials did well, small outperformed large, value outperformed growth. We like that.